everyone. Welcome to our Andersen webinar today. Our topic for today is for Canadian Departure Tax 101. It will be presented by me, Philip May, and Efrelyn Soyangco from our Edmonton office. So before we start, we just go over some of the audience participations. Just a quick reminder that our webinar is qualified for continuing professional education credits under the NASPA. So make sure to obtain the credit, make sure you attend the 50 minutes of our webinar, answer all the 3 polling questions. So after the webinar finished, our staff would issue the CPE credit certificate directly to you. Next is make sure you ask questions to our panel. We have a couple managers sitting on a panel collecting the question, and some of those questions will be brought to our attention at the end of the webinar. We will try to answer as many as we can. Next is after the webinar today, you will receive a survey from us about how you feel about our webinar today, and then topics that you would be interested in listening more. Last but not least, this webinar have the live transcript option. Make sure you turn it on by clicking the closed captioning buttons. Then we move on to our agenda today. First, we're going to have a kind of brief discussion about tax residency. Taxpayer have to get a better understanding on what's the tax residency. Then it kind of follow the question of when departure tax would apply. And then some of the common planning that regarding Canadian departure tax. And then also on the last bit of our webinar, we're going to cover the Canadian taxation on non-resident of Canada. So after they have left the country, what kind of Canadian taxation would apply on various income. So first, Efrelyn is going to discuss the tax residency for us.
Thanks, Philip. So when you are considering to move from Canada to another country, tax residency is one of the first issues to be addressed, along with the Canadian tax implications to face. This is because tax residency determines how much of an individual's income will be subject to Canadian income tax, since if you are considered a Canadian resident for tax purposes, then your worldwide income would be taxed in Canada. So a tax resident of Canada can be a factual resident or a deemed resident. Factual residency is based on a mix of facts and case law because it is not defined in the Canadian Income Tax Act. There's no bright line test, so we have to look at the residential ties or strong connections to Canada. So primary ties look at the location of the individual's home or dwelling place in Canada, the spouse or common law partner in Canada, or children or dependents in Canada. Meanwhile, secondary ties in Canada include like personal property, social professional memberships, economic ties like employment with a Canadian employer, bank accounts, financial accounts, Canadian passports or driver's license, and many others. So these are looked at collectively to assess the factual residency. If an individual is not a factual resident, then he may still be deemed as a resident of Canada if he sojourns or he is temporarily present in Canada for a total of 183 days or more during the calendar year. And even if an individual stays in Canada for less than 183 days, he may still be treated as an ordinarily resident, which is also considered as a factual resident. This happens if the individual's days in Canada are seen as habitual, substantial, and part of his routine life. Meanwhile, in foreign countries, the determination of tax residency follows the domestic law of those countries. So for example, in the United States, there's more of an objective determination, like the substantive presence test. So this is based on the number of days spent in the U.S. over the last 3 years. So if the person meets this test, then he will be generally treated as a U.S. tax resident. So because of these different rules between countries, an individual may be treated as a tax resident of both Canada and the other country. Therefore, in this case, we should be looking at the treaty tiebreaker rules. So the tax residency provisions in the income tax treaties that Canada has with other jurisdictions may need to be looked at, as this could override the factual or deemed residency determination. So these tiebreaker rules aim to determine the tax residency of person who is considered resident of both countries under the domestic law of each of those jurisdictions. So the aim is to determine which country has the primary right to tax the income of the person, while the other country may grant a relief such as tax credit or exemption from income to avoid double tax. So the treaty tiebreaker rules may vary per jurisdiction, but generally, as we can see on the screen, the treaties would apply the rules in this order. First, the country where the dual resident individual has a permanent home that is available to him would initially be deemed to be his tax residence. If he has permanent home in both countries, then his center of vital interest will be considered. These are the personal and economic ties, as we discussed earlier. If these ties are not closer to one country than to the other, then the treaty will look at the person's habitual abode. This is where the individual spends majority of his time during the year. If this is a tie, then the country where the individual is a citizen is considered. And in case of a dual citizen, then the competent authorities in both jurisdictions may engage in a mutual agreement to determine the individual's tax residence.
So,
So let's
I think we just want to provide some additional comment regarding the tiebreaker. Even though the 5 tests was listed here, the test would actually start once a determinative answer has been reached, like Efrelyn has mentioned. If at the permanent home that only one country have a permanent home, the test would stop, it would not carry on. So it would only be carry on for the future task if it could not reach a determinative answer for the earlier task.
Exactly. So now we can go to our first polling question. Just a reminder, we would have about 45 minutes to allow you to respond and click the submit button to get your answers counted for the CPE credit. So the question is, Canadian tax residency is a subjective determination based on which factors? A, primary home and place of work. B, spouse and dependents. C, club memberships, religious and social groups. And D, all of the above.
So now we will give you about 20 seconds to answer the questions. So a couple of things to emphasize here is it's a subjective determination. For the question, it lists both primary ties and secondary ties. So most of our audience picked the correct answer of the above, that first A and B would be primary ties, residency tie with Canada, while C is a secondary ties. There was no factor that outweighs the other, but the primary tie tends to play more importance in terms of determining if the taxpayer is a Canadian tax resident. So thank you, Efrelyn, for giving us some brief idea about tax residency. The reason why it's important is for departure tax to apply, it only applies to a taxpayer that was a Canadian resident and then ceased to be a Canadian resident at certain point of the certain time of the year. So you have to follow the definition of the residency for domestic law first, both Canada and the foreign country, and then have to verify if the tax treaty, the tiebreaker rule would apply to override some of the conclusions. So after reviewing the residency, that if we determine the taxpayer was a Canadian resident, and then after certain point stop being a Canadian tax resident, departure tax would apply. In general, departure tax apply by deeming the taxpayer to dispose most of the asset at fair market value on the last day of Canadian residency, and then immediately we acquire those property at the fair market value. So any gain or losses on the deemed disposition will be subject to tax on the last year of Canadian tax return. For example, if Mr. Smith just moved from Canada to U.S. as of June 1st when he accepted a new job. The whole family moved. After this point, he no longer have any residency tied with Canada. He would be considered as departing Canada as of June 1st. For the first 5 months of the year, the worldwide income would be subject to Canadian tax, and on also the gain from the deemed disposition of all his assets would be included on his current year of Canadian tax return and subject to tax in the years. So this is the general rules regarding departure tax. There was a series of property that are going to be excluded from departure tax. Some of the common example would be real property, resource, and timber property in Canada. And then also certain property that used in an active Canadian business. If you have inventory, capital property that was used in a Canadian business, those would be excluded from the deemed disposition. So it doesn't, any gain would not be subject to taxation. The other main category of property that is not subject to departure tax is also pension, registered accounts that including registered retirement saving plan, registered retirement income funds, tax-free saving accounts, IESP, those would not be subject to departure tax. And also stock options. So stock option, they are considered basically have zero value. They are not going to be subject to departure tax. And the last part that is not as common, that not most taxpayer is not aware of, it's certain asset that is owned by certain short-term resident.
Philip, can you elaborate more what short-term residents mean?
So short-term resident is immigrant into Canada that they live, that who will leave the country within 16 months of their arrivals. So they would have to be a Canadian resident for less than 60 months over the last 10 years of period. For those assets they brought into Canada, and if they leave Canada with those assets, they would be excluded from the deemed disposition. So for any taxpayer or any audience that are listening, if they come to Canada not that long ago and they're thinking about changing their residency again, the 5-year or the 60 months kind of milestone is become important. If they have, especially if they have significant amount of gain accruing those assets, they should consider about the timing of departure. By delaying or make the departure day 1 month early could play a significant impact in terms of the final tax liability on their Canadian returns. So with those in mind, we are going to discuss some of the common planning options that we have in terms of departure tax. So we try to break into phases, like there are a lot of consideration that the taxpayer could consider even before their departure in the anticipation of changing in residency. Because we know that departure tax basically deeming to dispose the asset, the taxpayer could even actively or by their own mind choose to liquidate certain asset. They could probably look at the market when the market is high, they could actively selling it instead of waiting for the deemed disposition to happen. That would have the taxpayer will have better control in terms of when the gain is realized at what price. Liquidating asset also apply to a Canadian private corporation, because private corporation usually could potentially be major asset of any taxpayer. If there is any business sale that could be mature before the departure, that's usually a good option to consider, because if the taxpayer departed Canada holding private corporation shares, the tax implication is usually tricky. It would be subject to capital deemed disposition again, and also any future dividend would be subject to withholding tax again. So there was some possibility of running into double taxation. So if the taxpayer could just liquidate a private corporation, it kind of solved the problems. In continue to discussing about private corporation, there was a strategy of declaring dividend from any private corporation that is controlled by the taxpayer. For a few reasons, the private corporation may have some share attribute that inside, including refundable tax on hand and capital dividend accounts. we want to make sure that the taxpayer fully captures some of those benefits before they leave the country. Some of those accounts would no longer available to the taxpayer after they cease to be a Canadian resident. For example, capital dividend could not be paid to a Canadian non-resident. It would be remain as taxable. So you basically have a capital dividend account sitting there, could not utilize it. And also by declaring dividend from a private corporation, it kind of reduced the value of the corporation, essentially reducing the gain on any of the deemed disposition of the shares. So you're reducing your departure tax payable as well. The next point is not as common. It only applies to certain scenario that is the taxpayer should consider realizing some of the gain in the registered accounts.
So Philip, can I ask here, can you elaborate why we would consider this as one of the option or plan to close and realize gain in registered accounts? As we discussed earlier, the registered accounts are usually not subject to deemed disposition rules in Canada.
Yeah, you're right, Efrelyn. Like those registered accounts are not subject to departure tax and usually either tax deferred or tax free in Canada. However, that same tax treatment was not necessarily true in the foreign country, the destination country. For example, in the U.S., they don't recognize the tax-free saving account status, or in certain states like California, they don't recognize the tax deferral account status for the registered retirement saving plans. So for example, if you have an ISP that you accumulated over your long career of time, you have a significant amount of gain that is accrued but not realized in those assets. If you move, let's say, to California without planning, and then you start withdrawing money and liquidating those assets and start withdrawing money from the ISP, the gain on those assets would be taxable in California. So it opens that risk of extra income that is going to subject to California taxation. So before the departure, the taxpayer should realize some of the gain. Essentially, you could just sell the shares at fair market value, buy it back the next day. Then now for whatever the foreign country's tax purpose, the cost base for those assets would be stepped up to the fair market value right before departure to minimize some of the impact for the potential future taxations. The next one is next option or consideration is a lot of taxpayer is considering renting out their principal residence because now they no longer living in Canada. They would just likely thinking about selling it, renting it out while they are living in outside of Canada. There was some consideration regarding the change of use for Canadian tax purpose. Whenever a principal residence that is personal use and changed to be a business use for a rental business, a deemed disposition actually happened at the time when the use of change, when the use of the property was changed. So as you can imagine that you likely bought the principal residence a long time ago. Now also giving the real estate market is going really hot. There were a lot of gain that is available. If you just change it to a rental property, the deemed disposition happened. The gain itself, it may not likely have going to be taxable due to the principal residence capital gain exemption. But however, there was option for you to plan it out in terms of deferring that or eliminating the change of use or the deemed disposition. Because after you rent out the principal residence, the rental period, the gain would be taxable in the future. So if you're anticipating that the value of the residence is still going up at an even higher speed than before, you could file the election to avoid the deemed disposition. And then what happened is eventually when the property was disposed in the future, there was a calculation of allocating the gain to the principal residence period and the rental period, and only a portion of the rental period portion of it would be taxable. So there was some planning. It's an option out there. It might not work out in all cases, and also depending on some of how the real estate market is going. The last but not least is some of the easy one is actually just deferring the departure tax. Deferring the departure date. Like I mentioned in earlier slides that any gain from the deemed disposition would be taxable on the last year of Canadian tax return. So using my same example as mentioned earlier, Mr. Smith, they have, let's say that if $100,000 gain, it will be taxed on the last year of return, adding on top of the first 5 months of income. I'm sure that all the audience would be aware that Canada have a graduated tax rate. So for those $100,000 of capital gain would be subject to a higher tax because with all the 5 months or the first 5 months of income, it will be subject to a higher marginal tax rate. If there was a chance that Mr. Smith could defer the departure, let's say, hey, instead of departing in December 1st or December 31st, I'm going to push it 1 day later to January 1st of the next year. He would be having the opportunity to enjoy a lower marginal tax rate on the same amount of capital gain from deemed disposition. Depending on the amount of the gain from the deemed disposition, the tax saving could be quite significant as well, with minor change of the travel plan and also the change of departure day. So with discussion about all the pre-departure planning, there is also some planning idea that is available if the taxpayer has departed Canada. So the common one is you could actually defer the departure tax. So even though the tax is payable, you could defer it until a future point of time. The departure tax would be payable, assuming that the taxpayer was properly filed the form and then able to defer the departure tax. Those tax payable would become payable upon a few different events. The first one is subsequent sale of the asset. If you defer the departure tax on, say, on shares of Apple, if you sell those shares of Apple after you leave the country, the gain or the tax on those shares would no longer be qualified for deferral. It becomes payable whenever in the year that you dispose those assets. And then the second event is at death. So if you pass away, the tax would be payable. And then the last one is return to Canada. However, there was way for potentially unwinding the deemed disposition and get rid of most of the departure, if not all the departure tax payable, which we will discuss in a later slides. For the taxpayer to defer the departure tax, they need to do a timely filing of the election to be filed before the due date of their Canadian tax return. However, in practical experience, CRA sometimes could be pretty lenient instead of accepting a late filing election for amended tax returns. So there was some chance that they would still accept the deferral, but however, there would be the interest charge from the time that the tax is due to the time that the security or the deferral has been processed. Once the request for deferring the departure tax has been accepted, the deferral is interest-free. So even though you owe, let's say CRA, whatever amount of departure tax, like $100,000, $300,000, it's an interest-free loan. They are not charging interest for those years that is outstanding. Given that right now, we are having a high interest environment, that could be a really appealing options for taxpayer that has larger amount of departure tax due. So when the taxpayer try to defer the departure tax, CRA would, or the Department of Finance would request a security if the departure tax is higher than $16,500. So essentially they try to protect or protect their own interest, make sure that the department would have a security available for them in the case that the taxpayer choose not to pay the tax. So the next slide, we're going to talk about some of the security that is acceptable for deferring departure tax.
Right, Philip. So the types of security that can be posted to defer the departure tax in Canada, as you mentioned, could include these items listed on the slide. So the bank letter of credit or bank letter of guarantee, this would be an irrevocable standby letter of credit or letter of guarantee issued by a Canadian financial institution. This essentially guarantees the payment to CRA if the taxpayer fails to meet his departure tax obligations. Many foreign banks also have correspondent agreements with Canadian banks for these purposes. And CRA also provides the required forms or format to the taxpayer, and these forms has to be delivered to the financial institution to complete the documentation. And should remember that there could be some bank interest charges to be incurred from these instruments. Next, if a mortgage on a Canadian real property is being considered, CRA requires specific documentation, like the latest third-party appraisal of the property, also current land title search, mortgage statements showing the current balance, or in case of a revolving credit, the amount of the maximum allowable balance, and also the latest property tax assessment and the property insurance policy. Also, for mortgage to be accepted as security, CRA requires that the mortgage balance should only be up to 75% max of the value of the property. So CRA has a specific definitive requirements in this respect. Next is the private company shares. Philip, can you help elaborate about how the private company shares can be posted as security to CRA?
Yeah, for sure, Efrelyn. As I mentioned earlier in the webinar, that a lot of time taxpayer or owner manager of business, the majority of the wealth could be hold onto a private company shares. So CRA or the Department of Finance would also accept the private company shares as a way of deferring departure tax. And if they're accepting the private shares, it would be a relatively cost-effective way of deferring departure tax comparing to all the other options. Like Efrelyn mentioned that some of the earlier options, they have some sort of cost related to it, either interest or there was some paperwork to be done. However, for private corporation shares, there was just some legal work have to be done. After that, there was no ongoing costs related to the deferral. One of the catch for using private company shares is that the shares could only defer the portion of departure tax attributable to the gain on those shares directly. For example, if a taxpayer having a private corporation that were $5 million have $5 million of gain, and another publicly traded portfolio that have $2 million of the gain, the private company share would only good for deferring departure tax on the $5 million gain. The $2 million gain from the publicly traded portfolio would have to come up with different security for deferring the departure tax. And also, if Department of Finance accepted the private company shares, they would have to put a security agreement on the shares, eliminating some of the possibility activity that you could do to the company. You would have to get CRA consent in terms of paying out dividend and some major transactions that could impact the value of the shares. So commonly it's really tough for a minor shareholder of a private company to post its shares due to all the restriction that would impact the other majority shareholders. So in a more practical sense, that we typically just posting private company shares that is controlled by the taxpayer that live in Canada, or even 100% owned by the taxpayer. In the case that the taxpayer only own a minority interest, there is still planning of pre-departure planning that could be done to increase, or by inserting a holding company to increase the ownership percentage to a high enough level. Those are available options that could be done if the planning was done ahead of time. And last but not least, CRA is also starting from last year, they start accepting publicly traded shares. Similar to the private company shares, they would only be good for deferring the departure tax on the gain from those publicly traded shares. So going back to my example, like 2 minutes ago, then the taxpayer could use those $2 million publicly traded shares to defer the gain on those 2 million gains. So this is just kind of a general discussion in terms of what the asset that could be acceptable as securities. The general process for this deferral of departure tax, kind of starting with the filing of tax return, the taxpayer calculated the amount of departure tax that is due on his last year of Canadian tax return. Election, a request of deferral was sent to the CRA, then an agent would be assigned to the file, then they would send a request back for a list of information and get a sense of what kind of security the taxpayer is going to use to defer the departure tax. And you essentially just working with the same agent throughout the process. The process, which could take a month, take several months to finish. So it's kind of a long process. Once that's been accepted that the departure tax has been deferred, it would be proved to be a rather cost-effective way of departing Canada. In real life, I think we have a lot of taxpayers are scared of leaving Canada for the reason of trying not to pay departure tax. However, departure tax is not as bad as it sounds if you have the proper planning done, and then if you are able to defer it. So a lot of the time that the additional income costs for staying as a Canadian resident could potentially even outweigh some of the costs related to the planning or the deferral of the departure tax. So let's move on to shift our focus a little bit into the foreign country, whichever the country the taxpayer is moving into. So we talk about that in Canada, there was the deemed disposition. So how about the cost base for those assets in the new countries? For some country, the cost base could be automatically step up. For example, Canada would be a great example. Any immigrant into Canada or become a Canadian resident, most of the asset would be automatically step up to the fair market value of on the first day of Canadian residency. For some of the country, they might not have that option, that the historical cost base would remain the same. However, the income tax treaty sometimes allows the taxpayer to trigger a deemed disposition to for the foreign country's taxation purpose. By doing that, those assets would have the same cost basis for Canadian tax purpose and also for the foreign country's tax purpose. There was a certain degree that you could avoid being the double taxation. What I mean for double taxation, for example, if you have stock of Apple, it got a accrual gain of $100, you pay Canadian departure tax first. But because, let's say for US, you never use the election, so the historical cost base remain as the same. And then 2 days later you sell it, or maybe next year you sell it, that $100 gain would be subject to US tax again. Depending on the timing, there could be potential lack of foreign tax credit, so you would be basically double taxed on the same amount of gain. One of the catch is just make sure that for the timing of foreign tax credit for US persons, mostly refer to US citizen green card holders, because you are subject to US taxation regardless of your residency status. So those deemed disposition triggered by the treaty election would be subject to US taxes as well. Typically, you are allowed to claim a foreign tax pay on the same amount of income that's subject to taxation in more than one country as a foreign tax credit. By doing this, you eliminate the double taxation. However, in the US Internal Revenue Code, they have limitation in terms of when you could claim the foreign tax pay as a foreign tax credit. Essentially, if you try to accrue the foreign tax pay as foreign tax credit, but you never pay it within 2 years, they would disallow it. This would be a trap for those taxpayers that try to defer the Canadian departure tax. because they never really paid it. If they defer it for more than 2 years, it might impact the credibility for those tax payable on their U.S. tax return. So some of the planning have to be really be thought through and make sure that we pick the most optimal option for the overall tax picture instead of focusing on one side of the border. So now we talk about the tax implication in Canada, foreign country. So what if the taxpayer decided to move back? In earlier slides, I mentioned that when the taxpayer moving back to Canada, any departure tax that has been previously deferred would become payable. However, the CRA has provided an option to those taxpayers that returning to Canada to unwind the departure tax liability. This option is obviously only applicable to those assets that the taxpayer still own. Any asset that has previously been sold while they are outside of Canada, the departure tax already become payable or paid. The mechanism for unwinding departure tax liability is they're going to make an adjustment, or the taxpayer have the election to make the adjustment to the cost base to those assets they basically brought back. Depending on the fair market value of those assets and the original gain upon departure, that could potentially reduce the departure tax to zero. They could just basically make adjustment to the cost base, which would have some impact for future taxation, but at least they could get rid of the departure tax that was due upon the original departure from Canada. In a rare cases that when the fair market value of those assets drops even lower than the original gain, there could be a portion of the departure tax could not be totally unwind, and that portion would be payable. Because of this mechanism, there was a lot of planning opportunity for appreciated assets. So, for example, I'm going to use my favorite example again, the private company shares. Let's say that if the taxpayer is entrepreneur having a startup business and then move to a foreign country for greater market exposure or anything. And then during their 5 years living outside of Canada, the value of those private company shares increased significantly. And then now they are ready for IPO. They could consider moving back to Canada, unwind their departure tax, and then those private company shares cost base would be adjusted for any gain that is accrued while the taxpayer is living outside of Canada. And for example, using some numerical example, let's say that when you depart Canada, you have company ABC that worth $100,000. 5 years from now, with your hard work, it's worth $10 million. So you could choose to come back to Canada, adjust the cost, and then now unwind the departure tax. Now those company ABC shares cost base for Canadian tax purposes could be worth $9,999,000. And then you could just sell it the next year for $10 million and you pay almost no tax on the gain. So that's just the mechanism for the deemed acquisition upon coming back to Canada and also the unwinding of the tax liability. So assuming if the taxpayer decided to unwind the departure tax liability that has been previously deferred and security has been posted on it, Department of Finance would return the security upon unwinding of the departure tax liability, because now you no longer owe the tax, you don't need to hold the security for those tax that is owed. Similar to the deferral election, the unwinding of the departure tax have to be filed with the first year of Canadian tax return upon return to Canada. So with the proper planning, departure tax is not as bad as it sounds, and also creating some opportunity if the right scenario happens with a substantial tax saving opportunity that is available for our taxpayers. So let's move on to the second polling question. So departure tax apply to deem dispose which of the following assets? A, non-registered investment in shares of stocks. B, registered retirement saving plans. C, Canadian real property. D, pensions. So this one should be relatively easy. We're gonna give you another 15 seconds. So I think it's a good time to talk through it. So the answer is A, non-registered investment in insurance stocks. So for those that still get this question wrong, go back to the excluded property slides. It basically excluded Canadian real property, registered accounts, and pensions. So the correct answer is A. However, there was election available for the taxpayer to trigger the deemed disposition on real property if they choose to do so, but it's not automatic. Comparing to non-registered account that it would have to be subject to deemed disposition. So continue on. So after the taxpayer has departed Canada, now what kind of Canadian tax exposure do they still have with Canada, or what kind of filing requirement do they still have with Canada? Efrelyn?
Yeah, so when a taxpayer becomes a non-resident of Canada, he will only be subject to Canadian income tax on certain types of income earned in Canada. For example, employment income. So when a taxpayer works in Canada, his employment income would be subject to Canadian income tax, because based on the marginal tax rate, unless there's a tax treaty provision between Canada and the resident country that would provide an exemption. Another one is business income. So non-residents who conduct active business, engage in a business in Canada, for example, self-employed individuals, may be subject to Canadian income tax on the profits earned from that business. The rental income would be by election. So rental income from a Canadian real property paid to a non-resident of Canada is generally subject to non-resident withholding tax, 25%, on the gross rental amount. But there is an election that can be made to reduce the withholding tax of, well, the tax rate remains at 25, but it could be imposed on the net income instead of the gross rental income. So there will be CRA forms and tax filing requirements, tax returns to report the rental income and expenses from the property. For the sale of taxable Canadian property, Philip, can you tell what happened when a non-resident disposed a taxable Canadian property in Canada?
Yeah, for sure, Efrelyn. So when a non-resident of Canada dispose of Canadian real property, the proceed would be subject to withholding tax. And they have the option of filing a certificate of withholding to reduce the withholding tax based on the total proceed to the capital gain. So you could see that big difference if you have a rental property that is worth, or a Canadian property that worth $1 million, which you acquire for $800,000. If you do nothing, the tax would be based on the $1 million proceed. You're going to withhold 20%. And then if you file the certificate of withholding, they would be only based on the gain of $200,000. And also the taxpayer would have to file a Canadian tax return, can file a Canadian tax return to report the actual gain, some of the selling expenses, and calculate the tax. And if there was any difference between the tax withheld and the final tax liability, there would be likely a refund or a tax owing. So that's the federal income tax side. In certain cases, provincial tax and federal surtax could also be applicable, depending on the type of income. For example, employment income and business income that is tied to a Canadian permanent establishment would be subject to provincial tax based on the location of the permanent establishment and the location where your service was provided. For example, if the taxpayer has already moved out of Canada, but they still working for their Canadian employer and travel back to Canada regularly for either attending business meeting, performing work, employment income attributed to those service performed in Canada and then tied to that Canadian permanent establishment would be subject to both federal income tax and the provincial tax. On the other hand, if the taxpayer receive income that is not employment or business income, let's say only rental income, they would be subject to a federal surtax. The federal surtax is the 48% of the federal income tax that is payable, try to mimic kind of the provincial tax that is payable. But instead of actually going through the provincial tax, they just charge the 48% of the federal income tax payable, not the income, but just the tax payable. So assuming that that's the scenario, that when the non-residents still going to be subject to Canadian tax and have to file certain form of return or withholding certificate. And there was also other type of income that is commonly received by non-residents.
Right. So some Canadian payers of income to these non-residents are required to withhold a portion of such payment and remit that amount to CRA. So as this is provided under Part 13 of the Canadian Income Tax Act, we commonly refer to this withholding tax as Part 13 tax. This applies to Canadian source income paid to non-residents, like dividend paid by Canadian corporation, rentals, royalties, also pensions, annuities, and others. So this withholding tax serves as an advance payment of tax of the non-residents' Canadian tax liability to ensure that the non-resident taxpayer has paid his Canadian income tax obligations. So if adequate withholding tax or the correct withholding tax amount has been withheld and remitted to CRA, then the taxpayer would no longer be required to file a tax return. So the tax rate of withholding would vary depending on the type of income. Under Canada, it's generally at 25%, but some tax treaties could also provide some reduced tax rate, could lower or it could exempt the income from taxation. Philip, do you have some common examples of how tax treaty could affect or reduce the tax rate, say from 25% lower?
Yeah, for sure, Efrelyn. So some of the common example, including dividend, like Efrelyn has suggested, if you look at the Canadian domestic law, the withholding tax rate would be 25%, but between, let's say, Canada and U.S. income tax treaty, it will automatically reduce to 15%. And if the shareholder is also a corporation that owning more than 10% of the Canadian corporation, it could be further reduced to 5% instead. So usually in real life example is we would advise our client to make sure that whoever the investment advisor or whoever the payer of those income is aware and agree that the income will be subject to a lower tax rate, make sure that the appropriate amount of tax will be withheld correctly at source. In earlier slides, earlier comment, we were saying that, hey, it would be withheld at source, no need to file a tax return. However, if the payer of the income didn't withhold the correct amount, let's say they withhold 25 instead of 15, the taxpayer could file a letter basically with CRA saying that based on the treaty, it should be subject to 15. Now they're requesting that extra 10% to be refunded back to them. So there was still some paper filing requirement if the correct amount was not withheld. The next point is about tax exemption. Is the treaty sometimes could even change the taxability of certain income that the income would no longer subject to Canadian taxation. One of the common example is CPP benefit, OAS benefit. If the taxpayer moved to US based on the treaty, the income would not be subject to Canadian tax, not even withholding tax. The income would only be subject to US tax as if they are Social Security benefit. So there are some common theme here that whenever we're dealing with cross-border tax, the starting point is always domestic law. And then we also have to look at the tax treaty to see whether it overrides the domestic laws positions. So now let's move on to the final polling questions. So after departure from Canada, a non-resident is taxable on Canadian source income, including which of the following? First is rent from Canadian real property. B is dividend from a Canadian corporation. C is income from employment service. D is all of the above. Again, 30 seconds. One of the comment here is also that we listed a lot of different type of income. The question is whether it's taxable, but it could be totally subject to different type of tax and also different income tax return filings. For example, rent would be subject to one type of tax return, and employment income could be subject to another type of income tax return filing, while dividend would be only subject to withholding tax. So if the taxpayer happen to have all these three types of return, three types of income, even though all of them is subject to Canadian tax, it kind of all reflected on different forms or different ways. Just for your information, it's not just one return capturing everything. So thank you for the participation. So I think right now we concluded our presentation. We are going to stay here for questions. Before we answer our questions, another reminder about our survey is make sure you complete our survey, tell us how we can improve, and some of the topics that you would like us to cover in the future. So now we would just open for a question that our panelists has collected over the presentation.
Hi, Philip. Hi, Efrelyn. We have some questions from our audience in here. So one question is, if an individual has moved to the U.S. on a work visa, but the spouse continues to live and work in Canada, assuming the individual living or working in the U.S. has a permanent home, U.S. bank accounts, and lives there habitually, does the CRA ever reject the declaration of the departure tax?
Okay, thanks, Kenneth. I think I'm just trying to collect all the facts. It seems the taxpayer has moved to the U.S. but still maintain a permanent home in Canada while having another permanent home in the U.S. and they are having all the ties with the U.S., having ordinary residing in the U.S. The other important fact that's omitted that I have to make assumption is I have to make assumption that he does spend over 183 days or meet the substantial presence task in the U.S., assuming that he worked there regularly. The reason I make that assumption is for U.S. tax purpose, having a permanent home or working there does not necessarily mean the taxpayer is a resident. They have to count the number of days he's physically present in the U.S., which is the substantial presence test. Let's say that if he does spend 183 days in the current year, then he would be a resident of the U.S. based on substantial presence test. And the other thing that is not provided is all the facts or the ties with Canada. We know that he has one home in Canada, but how about other ties? Does he have a family in Canada? How about other secondary ties like social club memberships, financial asset, driver license, health? I'm going to have to make some assumption that assuming he does have some residency tie with Canada, maybe enough, but to be a Canadian resident. This is not as clear cut as the US when they just count the number of days. For Canadian residency purpose is rather a subjective test. They never tell you how many ties is enough, which one is more important. Let's say that, hey, if you have a permanent home in Canada and permanent home in the US, which one is more important? So there was always some degree of judgment or risk involving determining Canadian residency. But let's say that if he does have enough to be a Canadian resident, we get into the situation that he being a resident of Canada and US at the same time, then like Efrelyn has discussed, we would have to move into the income tax treaty, look at the tiebreaker tax, and start applying those tasks one by one. The first one is permanent home. So we know in this case, he has home in both places, is a tie. So we move on to the center of vital interest. Vital interest typically including the business interest or personal interest. We know that he's working in the U.S. So more obviously that the business interest tie is to the U.S. If his family move with him to the U.S., then the personal interest would be also U.S. Then he would be a U.S. resident. The whole task basically stop. Canada, he's no longer a Canadian resident. And I think the question also asking whether CRA would question it. We don't typically see a lot of audit or review in terms of residency. Even they do, basically we would have to draft the explanation using the same logic about the residency for US purpose, Canadian purpose, and then try to applying the income tax treaty and come to the conclusion. So if that's the case, there should be no problem for them to accept the non-residency status.
Thank you, Philip. We have another question from our audience. If one of the spouses, let's say A, departs Canada for the US on a work visa, and the other B lives in Canada, I think you have already discussed then what's the residency status of A for Canada and the US. And in that case, for principal residence that is jointly owned, can that be converted into rental without filing for NR6, assuming the person B does not live in the principal residence anymore? The other person B lives in Canada, but does not live in the principal residence anymore.
Okay. So let's address, there were a few questions here. I think the first one is about the residency status. Again, the same logic or same kind of thought process. You look at the domestic law and then look at the treaty. I think in this case that the personal, I assume the taxpayer A have a permanent home in both Canada and US. So it's a tie for permanent home. The next one would be center of vital interest. In this case, business would be the US, personal, likely Canada, given that the spouse is in Canada. Then the next one would be habituable, which is the place that the taxpayers more regularly stay for the night. So assuming if, depending on kind of the split for the where he stay, if he stay significantly more nights in the US compared to Canada, he would have a habituable in the US. But if the case got reversed, he spent more night in Canada, he would remain a Canadian resident. So there are some more facts that have to be discovered first. The next question is related to the principal residence. For the NRC, it depending on the ownership of the property. So is it jointly owned, each one own 50%, or there was some planning that could be done that A is transferring his shares to B. Now B is becoming the sole owner of the property, because the NR6 or the withholding tax requirement is based on the residency of the owner. So if you think about it, if 50% is owned by US person, 50% is owned by Canadian, then the NR6 or the withholding requirement would be only applicable to 50% of the interest, 50% of the income. If the taxpayer want to get rid of it or get rid of this requirement, he could consider transferring the 50% interest to B or vice versa.
Okay, thanks, Philip. I don't know if we still have time for a last question.
I think we could briefly talk about the last one.
Okay. If the company is worth 1 million when a person migrated back to Canada, do you need to pay certain tax as a non-resident for the increase in the value?
Yeah, so this is a quick one. I think the short answer is no, assuming that the same company, this is the same company he had when he originally departed Canada, and then either the departure tax has been paid or deferred. Any appreciation while he's living outside of Canada would not be subject to Canadian tax. what happened is if he moved back owning that same corporation, the $1 million would become the cost base for Canadian tax purpose. And let's say that next day he sell it for $1 million, he pays 0 Canadian tax. So I think that's that concludes our webinar. Again, here is the teaser for our upcoming webinar. Next one is September 27 about structuring cross-border business. And then in another couple of weeks, we have U.S. state and local taxes. Again, thank you for everyone for attending our webinar. We're looking forward to seeing you in our future ones. Thank you.
Thank you.